Picking the right ETF, it should be easy, right? But it's really not. So today, we're going to build a system to fix that.
Okay, let's just get this out of the way. Here's the uncomfortable truth. With thousands of ETFs out there, all that choice, it isn't a feature. It's actually a bug. It's totally overwhelming, and it makes finding the right one feel, well, almost impossible.
But look, you're not here for some hot tip that's going to be old news next week. You're here to build a system, a real framework for making smart decisions. That's what actually builds long-term wealth. So if that sounds like you, subscribe to Money Mindset, and let's actually get into it.
You know that feeling, right? That pull of the next big thing? We've all been there. You hear about some new trend, some game-changing tech, and boom, that fear of missing out, that FOMO, it just kicks right in. You feel this pressure, this need to get in on it. And that's exactly where the thematic ETFs come into play. They're built around these exciting stories, AI, robotics, clean energy, you name it. And they are absolutely brilliant at capturing our imagination. But here's the catch. They're also designed to tap directly into our emotions. And for an investor, that can be a really dangerous trap.
So this is the key takeaway. Trying to predict what's going to be hot next is a total loser's game. The real solution, it isn't a better forecast. It's a better filter. We need a logical, rules-based system to just cut straight through all that noise.
And for this filter, we're not just pulling ideas out of thin air. We're going to use some proven financial science to build something that actually works. Okay, so the foundation of our entire system is something called the Fama French three-factor model. It sounds complicated, but it's a Nobel Prize-winning idea, and the core of it is pretty simple. It found that besides the overall market, two key things have historically led to higher returns: how big a company is and its value. All right, let's break down that first factor, because when it comes to long-term returns, it turns out size, well, it really does matter. The model calls this the size factor, or SMB, for small minus big. The idea is incredibly straightforward. Over the long run, the stocks of smaller companies have, historically, outperformed the stocks of larger companies. So what does that look like in the real world? Well, on one hand, you've got your large cap ETFs like SPY, which tracks the big established companies in the S&P 500. And on the other hand, you've got small cap ETFs like IWM, which tracks smaller companies in the Russell 2000, the ones with a lot more room to grow. Okay, on to the second piece of our filter, value. This is what the model calls the value factor. And what it means is that historically, stocks that seem kind of cheap compared to their actual net worth, what's called their book value, have tended to outperform the really expensive stocks that are priced for massive future growth. Think about it like this. Value investing, it's like buying something solid, reliable, maybe even a little boring that the market has overlooked. Growth investing is more like betting on that flashy, next-gen gadget that everyone is buzzing about. Now, both can have their moments, but financial science suggests value has an edge over the long haul. So a value ETF is out there hunting for those underappreciated stocks. A growth ETF, on the other hand, something like IWF, is filled with companies everyone expects to grow way faster than the market. It's a completely different philosophy. All right, we've got our two factors. Now for the final, and I'd argue the most important piece of our filter. This is the one that's totally non-negotiable. You have to scrutinize the costs. Every single ETF has what's called an expense ratio. It's the fee you pay every year, whether you notice it or not. The SEC points out this is made up of a few things: management fees, marketing fees, and other operational costs. And these fees come directly out of your returns. And the impact here is just staggering. A tiny 1% difference in annual fees, it doesn't sound like a big deal, right? But over 20 years, that 1% can slash your final return by almost a quarter. We're talking 23% less money in your pocket just for picking a cheaper fund. That's huge. So let's bring this all the way back to where we started. Remember that super hyped, disruptive tech ETF that caught your eye? How does it hold up when you run it through our filter? Does it actually fit the rules you've set? Is it tilted towards those proven factors like size and value? Are its costs as low as they can possibly be? Look, you've got to choose ETFs that fit the rules of your plan, not your emotions. That's how you stay consistent. So here it is, your action plan. It's 3 simple steps. 1. Define your factors. Decide if you want to lean your portfolio toward those scientifically backed ideas, like size and value. 2. Find the ETFs that actually match that criteria. And 3. Be absolutely ruthless about the costs.
Get them as low as possible. Because at the end of the day, your plan, that's the signal. Everything else, all the hype, the headlines, the hot tips from your buddy, it's all just noise.